please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Commodity Champions, and I'm Manisha Gupta. India may overtake China to become the biggest source of oil demand growth by 2024. This according to a report released by leading global energy research firm Wood Mackenzie, which says that China is expected to see a decline in demand growth from 2024 to 2035. This report comes at a time when the fuel prices in India seem to be inching towards a new record high each day. The report highlights that the India demand is growing due to its expanding middle class and its growing need for mobility. Meanwhile, China's demand is becoming sluggish due to the replacement of gasoline and diesel with alternative energy sources as well as an efficient freight system. The report also warns that if India doesn't reduce its reliance on oil, it could lead to a further impact on the growth of its economy, with a major impact on currency, current account deficit and trade deficit. The research firm's report also goes on to suggest certain measures that India can take up in order to reduce the usage of oil. Joining me now to take this report forward is Sushant Gupta, Director, Asia Pacific Refining at Wood Mackenzie. Sushant, hi, good to have you. In the last couple of weeks, we have seen a gain of 10% in the crude oil prices. First of all, what is your sense? Because the Iran sanction conversation has been around for some time now. We also have seen the US weekly inventories declining. What are you picking up as a major fundamental reason here?
Well, I think you're right. We are seeing in the near term, we are seeing a tightness in the market driven by all the supply outages we are seeing, Iran, Venezuela, Libya, all confluencing at the same time. And we are seeing the demand, even though the latest numbers are slightly weaker than expected, but we still see oil demand to be quite strong in the robust in the Q4 of this. That again puts market a bit tighter, and I think it's a fine balance between geopolitical issues and the market fundamentals. So we expect markets to remain a bit on the tighter side as we head into Q4. But not to forget that there is a potential supply which can come in from the OPEC, to fill the gap from Iran, Venezuela, and Libya. So that potentially could start tilting the market towards the other side. So we expect Saudi Arabia, Iran, Kuwait, and UAE, and including Russia, to add around 1 million barrels per day as we head towards Q4. And then once the supplies start hitting the market, we expect that gap to be filled up. And hence the markets should start tilting towards a bit more balance towards the oversupply situation as we head towards Q4, Q1 of 2019.
Sushant, so what's your sense on the crude oil prices going forward? I mean, there are reports suggesting that 78 to 80 per barrel is a possibility for Brent for the very near term. Is Wood Mackenzie also watching those numbers?
I think we, for Q4 of this year, we are forecasting between 75 and 76, dollar per barrel, mainly driven by geopolitical issues, not essentially driven by market fundamentals, because we believe, the market could potentially see the supply coming from OPEC. But given the geopolitical issues, we expect prices to remain around, 75 to 76 dollar per barrel in Q4. But average for 2019 in our view is roughly around $73 per barrel of Brent for next year.
Fair point. We are looking at that number as well. But Sushant, what do you expect in 2019 then? Will the geopolitical tensions or the global trade concerns ease any bit? And if not, then what is the impact or calculation that you're taking in from these factors?
Yeah, I think, and that is a potential downside in our risk. So if you look at for next year, we are anyway forecasting a lower oil demand growth. And one of the reasons for the lower oil demand growth is a lower GDP growth forecast, for China. And essentially, a bit of that is involved, is driven by the trade issues, the trade dispute between US and China. Now, US and China together, if you look at the demand, they account for roughly around 40 to 50% of the global demand growth. Now, if these two countries are disputing on particular issues on trade, we could potentially see for next year at least, and if the trade dispute escalates, to say $200 billion, which they're talking about, then we could potentially see a larger impact on the oil demand, and that can put a downward pressure on the prices. Now, having said that, the market, as I said, it's very fairly balanced between market fundamentals and geopolitical issues. On the upside, we could potentially see, issues with Iran escalating and Iran flaring up, seeing their other OPEC members, putting more volumes in the market, and hence that could again put an upward pressure on the prices. But generally speaking, we are seeing the markets remain oversupplied for next year.
Your point is well taken. Sushant, you also mentioned that the demand growth for 2019 might see a bit of a dip, but that's not true for India, right? Because the demand growth here has been quite robust. Is that how you see it going forward as well? Because we've seen nearly 7% of a jump up in annual demand growth in the last couple of years. What number are you now working with?
Yeah, you're right. I mean, I think given, the slowdown in the demand is a general trend which we will see in the medium term. But India is actually emerging as a brighter spot, as people are talking about peak oil demand. So India's demand growth will still remain robust. And I think in the medium term, we are forecasting that India's demand growth to account for around 1/3 of the global oil demand growth. Now, we don't expect a slowdown in India in the medium term. We expect the demand growth to remain robust. The slowdown essentially is coming from the more advanced economies, US, and also some slowdown which you're seeing coming in from China. But India's demand growth still to remain robust, which again I think leads to some of the medium-term issues around on the refining sector, which they have to ramp up their capacity additions to meet this growing oil demand growth. So completely different issues for India compared with the global oils market.
Oh, well, yes, Sushant, couldn't agree more than that. Yes, what we are seeing in India is quite different in sense of issues and problems and solutions as perhaps as well. But in that light, how would you look at India? Because in recent days, we've seen the crude oil prices at a one-month highs, the rupee falling to record lows, as has been the case almost every day in this week. Clearly not a good sign for India, right? So now, with the concerns that India is working with, over-dependence on global crude oil markets, what really is the solution going forward?
Well, I think so that has been one of the government's aim to lower its dependency on oil. But having said that, the policies which were driving, to reduce the dependency on oil, for example, increasing the usage of biofuels, putting in more efficiency, increasing more renewables into the overall energy mix. And I think that potentially will take more time, right? It's not an immediate impact which we can reduce the import dependency. So today, India's oil import dependency is roughly around 85%. We expect it to rise to around, very close to 90% in the next 5 years. Even though we expect increased usage of biofuels, increased renewables in the power mix in the medium term, but overall, the energy demand in India is growing so rapidly that there is need for all energy or fuels products, oil, gas, coal, as well as renewables. So oil demand grows by 3.5% CAGR in the medium term, gas demand grows by 5% CAGR, and renewables grows by double digits. So, so there is place for all the fuels in the market which is growing so rapidly. And it is hard to see how oil dependency can be reduced in the medium term until unless the government gets more aggressive on its renewable fuels capacity growth or its electrification of the transport sector, particularly on the two-wheeler side.
Sushant, I like it when you say that there is place for all kind of fuels for India. And as you also said that the intent is right from the Indian government and they are working in the right direction as well. But, it would take, would you say, next 5 to 7 years before we actually see electrification, or whether it's about hybrids, solar power, biofuels, etc., take its own time or take over from the over-dependency that we have on global crude. So as the biggest consumer of crude in India, what should be India prepared for?
Well, I think, I mean, if you look at it, right, I mean, it's a good thing, right? All the fuels products are rising, and I think that's a good thing for India as a country. We'll see increased investments in all this space, which again may, means, higher economic growth, more jobs for people. So, which in effect is a good thing. But in terms of, what you should be looking for, we'll see increased, usage of biofuels going forward. We'll see increased electrification of the transport sector, but we are seeing that the government is focusing more on the taxis and the two-wheelers, which I think is the right step to go forward to, right? I mean, rather than electrifying the private vehicles, we should focus more on the taxis such as Ubers and Olas, which actually drive more than the private cars, which will effectively have a higher impact once electrified. And the government is also looking at gas penetration into with the city gas distribution network. So I would say, right, I mean, from the consumer's point of view, they will have to look at what are the most economical mode of transport available to them, and they will essentially shift their demand and behavior towards that mode of transport.
Well, yes, adaptability will have to come. But what also your sense is into the global markets, because the non-OPEC producers like US, Canada, Brazil, what is the expectation that we might see an increase in supplies, and how much is that going to be, and will that really bridge the gap? And what really are the markets holding on to in sense of fundamentals as we get into the new quarter?
Yeah, so I think outside OPEC, right, the biggest driver of supply or the production is US shale oil, right? So it's just so overwhelming. So we do see some growth coming in from Canada, Brazil, Guyana, but the US supply growth for next year, for example, is roughly close to around 1 million barrels per day, which is almost about 50% of the overall growth we'll see in the market for next year. So it's so overwhelming. So we do see growth coming from Canada, Brazil going forward, but they are much less compared to what we see from US shale oil.
Fair point. Sushant, one more question before we let you go, and this really is about the investment, because for the last couple of years we were discussing on how the sector in energy really has been underinvested, and that of course was a big concern, that you could see a explosion in prices going forward because the demand is strong but the investment is not. How have you seen those numbers change around?
Yeah, I think they have been picking up since last 2 years. So I think we saw a sharp decline in overall investments in upstream sector as a result of the oil price crash since 2014. But again, we have seen with the rise in the oil prices, upstream companies are getting more positive with the outlook of oil prices, and hence we have seen some uptick in the investment trends in 2017. Now, just for example, for this year, we are forecasting roughly around 25 FIDs to be taken on the upstream side. So these are projects which will they will take a final investment decision to go ahead, which actually is a very positive sign. If you look at 2014, 2015, the number of FIDs were very, very low. So this does say that the optimism in the industry is coming back in the upstream sector. People are again taking FIDs and starting to invest in the upstream sector, and we should drive the growth for supply in the medium term, which is very well required. So if you look at our numbers in the medium term, we do see some of these FIDs which are being taken today, and the supply from these projects are still required in the medium term, because US will not be able to meet the entire global oil demand growth in the medium term. So we still have to fall back on these conventional FID projects in the medium term.
All right, Sushant, we'll let you go at that. Really appreciate you joining us with all that sense on what really has been come out in the report. So clearly some key takeaways are that there is optimism in the oil market, in the investment side of it. The global demand is expected to be steady. For the Indian markets, it really is about over-dependence to the global crude to the tune of 90% of our crude requirements. How India can really tackle this is going to be a big question going forward. Welcome back, and you're watching Commodity Champions, where we are discussing the future of crude and, of course, India's dependence on imports there. Narendra Taneja, National Convener, Energy Cell, BJP now joins us on the show. Mr. Taneja, hi, thank you so much for joining us. I'm assuming you heard the conversation on the report from Wood Mackenzie. What is your sense if India's, dependence on imports is going to increase, and the way the global markets are right now, what are the kind of solutions that the government and the ministry should really be looking at right now?
Well, very good question. You see, the point is that we are a fossil fuel economy. We have got, of course, coal is the king, and then oil, and consumption for natural gas is also rising rapidly. And unfortunately, when it comes to natural gas and coal, our dependence on imports is only growing. 50%, by and large, natural gas requirement is being met by imports, and oil is in the region of 82 to 85% almost. It includes, of course, a part which we import, refine, and then export. That's part of the thing. But still, when you look at our economy, ours is basically hydrocarbons economy. And though renewables are doing very well, we have got rapidly expanding, renewables footprint in the country, and we are being noticed and even admired by the global community on this. But the question remains, at the same time, look at the size of the population in the country and the, demand growth for energy. We have no alternative but to keep on basically go aggressively acquire wherever we can and bring that oil and gas in whatever form energy available, bring it to India. And I'm afraid it's not really going to change anytime soon. When you look at India's global energy mix, India's global energy mix is close to 90% fossil fuels. And renewables is expanded, but renewable share is still very, very small.
Right.
Now, we are doing well, but as I said, that this challenge remains, and oil, in my personal analysis, oil will remain central to India's economy for at least another 20-25 years. And even, for instance, if we, expand even more rapidly when it comes to renewables, and natural gas is also going to expand very, very fast. And in both the commodities, unfortunately, we have no alternative but to depend on imports, because we are not as blessed as several other countries when it comes to domestic reserves of oil and gas.
Mr. Taneja, the next point really is, when you look at the July crude import bill, that really stands at around $10.2 billion, which is a huge 76% of a jump up as compared to July previous year. So, and August perhaps would be higher because we've seen crude oil prices gaining in this month again. So what really are we doing to tackle that? I understand your point when you say that it is going to be a longer term, time-consuming solution that we would really come to. But immediately, is there anything that the government is looking to do?
Well, I think immediately, but the government has, very few options, unfortunately. I'm going to be very candid with you. Now, you don't have too many options. I mean, even when it comes to renewable, there is a limit. You are growing rapidly, but there is a limit. And that's the reason, one of the reasons, or rather the key reason is, renewable growth is mainly, in the area which are connected with the grid, is grid-connected renewables and not so much of the distributed, renewables. But when it comes to looking at the demand, looking at the growth in the automobile sector, looking at the aspiration that people have in terms of consuming more energy, whether it's air conditioner or a new car, motorcycle, and so on and so forth, what options you have got? But I think the only options we have got is to actually grow rapidly, grow the size of the economy rapidly. The GDP figure which has just come out are very impressive. So I think, let me put it this way, let's say in 10 years from now, if we are able to expand the economy, take it near $8 trillion, $8 or $9 trillion, we will have the capacity to pay for the higher oil or gas import bills. And if we can, 15 years, 20 years from now, we become $12 trillion economy, probably we'll be very, very easily able to absorb the import bill, whatever the price of oil and gas, though the prices are not going to go through the roof, I personally believe. But at the same time, we will be in a... So the only option before us are basically two, better economy manage well, go for more, energy efficiency, make our companies more efficient, bring in the latest technology, try to explore the maximum possible within the domestic basins, both offshore and onshore, within the country, acquire oil assets overseas, as fast as we can, but at the same time expand the economy. That is crucial. If we are not able to expand the economy and become 15 years from now a large economy like $10 trillion, then we are going to face serious issue. So in my view, There is nothing we can do in terms of oil, we will need to import more. Nothing we can do in terms of natural, we will need to import more. But if we keep on expanding the economy, probably we'll be in a more comfortable position to deal with this situation.
Well, that's a comforting thought, really, that the robust growth in years perhaps might lead us to absorbing higher crude oil prices better. But Mr. Taneja, also let's talk about the the hybrids, the biofuels, the solar power, the electrical vehicle theme that the government seems to be pushing right now. Of course, the global experts do suggest that we are going in the right direction. The intent is right. How much time do you see India actually take before we can actually start using all of this on a broader range?
Well, biofuels, I'm not as optimistic as many of my colleagues within my own party and the government and some other experts. You know, we are an economy heavily based on agriculture. If we, for instance, go more aggressively in that direction, we may end up importing more food. So I think there we have to be a little bit more careful. So I'm not as optimistic as many others. When it comes to solar, I think we are doing very well. The only thing we need to fix is our dependence on equipment from China and other countries very high. Almost 90% equipment that we need are being imported. So that's again compromising with the energy security. Instead of oil, you are importing equipment. Your dependence on dollars that means will continue. So my own view that when EVs, again we talk of EVs by 2030, Delhi, Bombay are going to have EVs, or maybe mainly only EVs. The question is, in order to produce electricity, you need fuel. You need oil, you need natural gas, or you need coal, or you need uranium. And again, except for coal, for all other commodities, we need to import, even uranium. Now, so you need, all the fuels in order to generate electricity. Electricity is not energy, it's a product of fuel that we need. So again, the picture will be, that means we'll need to import more energy, convert, set up more gas-fired power plant. You consume roughly 80,000 megawatt electricity being generated using diesel in this country. So we will need to import even more diesel. So these are tough questions, and we'll have to find an answer. In my own opinion, we need to recast our India's energy mix, but at the same time, unless states are on board, public opinion is on board, is not going to be that easy. The only way, as I keep on saying, is invest more in renewable, invest more in green fuels, including green petrol, green diesel and on, and at the same time make sure you're expanding the economy. Reform economy as fast as possible. Expand the economy. If you're not expanding the economy, you will end up compromise on the fuels front, on the energy front, including energy security.
Point taken, Mr. Taneja. Also, one final question before I let you go. What really is the sense on of course, we've seen the crude oil prices gain up by 10% in last 2 weeks, and that's quite volatile. But we also have seen record high petrol and diesel prices in the Indian markets with the record lows in case of rupee. This does look like a very tough time, and especially as we are into the election year, doesn't really augur well, isn't really a comforting thought where we stand right now. What is the mood going forward from here? What steps do we need to take, at least in one direction, to ease the concerns here?
Well, two things. First of all, when it comes to crude oil prices, I don't think prices are going to go down anytime soon. I think we as an economy, we as a country should be prepared for crude oil prices is a rather, very broad band I'm talking about, but something between $60 to maybe $100. I'm talking over the next 3 years. So we should be prepared. Over the next year is going to be $60 to $100. So we have to prepare accordingly. But when it comes to, the retail prices in the country, I feel there is no alternative. Political parties have to agree. The government have to bring them on board and bring petrol and diesel under GST. But that does mean, people will get petrol and diesel, a GST of only 18 or 28%. You would need to impose some kind of cess. States may also want to, bring in some kind of cess. But there will be more transparency, and there will be kind of, the consumer will be better informed. But when it comes to cheap petrol, cheap diesel, whatever rework you do in terms of the architecture of our pricing, I unfortunately don't think we will get we will get a very, very big and good news anytime soon. Unfortunately, as long as dependence on import is there, this is a commodity which remains more or less in the same situation, in the same spot as it is today for a long time to come.
Well, that point is taken. So no really getting out of where the crude oil prices or the imports that have been increasing for India goes. But of course, the steps being taken, the economy that's growing and the GDP numbers, as Mr. Taneja mentioned, are some of the bright spots here. Thank you so much, Mr. Taneja, and Sushant Gupta as well. That, of course, has been a straight conversation on the crude oil prices and where India really stands and the expectation that we are looking at increasing over-dependence on imports. That's not going to go away anytime soon there. But with that, that's all the time that we have on Commodity Champions. Thank you for watching.